Good morning, my dear future chartered accountants. Hope everybody is doing great. First of all, can you please confirm that my voice is audible and the PPT is visible? Yes, thank you. Okay. It's hard, especially on Sunday morning to join, but that is the trait of CS students, isn't it? We don't have any holidays, we don't have any festivals, we don't have any celebrations. But all these things are for reasons, and you would have learnt in deferred tax concept, timing difference. That is, you're sacrificing now, that is, you're building an asset, and you'll get the benefit sometime in future. Anyways, we are doing, or we just did in the previous session, I would say a mini workshop on stock market basics. I hope you have learned something new and something interesting. Now we'll go to the next chapter, equity valuation. Relevant chapter from Institute syllabus, Institute chapter name. They have security analysis where they had talked about bond as well as equity. And here I take only the equity parts. And in case of uh, corporate valuation, and again they talked about equity. So these two chapters are merged, and that is what I'm calling it as corporate valuation or equity valuation. As the name suggests, we are focusing on valuation of equity shares of companies. In bond valuation, it was pretty much straightforward. The basic definition of value, present value of future cash flows, and in bond valuation, future cash flows were fixed. We knew the coupon and we knew the redemption price. We discounted it. We got the present value. We got the value of the bond. You can also call intrinsic value of the bond. And we also found out elements like YTM, the discounting rate such a way that we get market price as the present value. Those things we have found out where things were pretty much straightforward because the cash flows are known in advance. They are certain cash flows. But equity is definitely complex. For a simple reason, the benefits, the cash flows are not fixed. So we have various methods, various theories, various opinions. There is no one standard method that you have to value the equity share in this approach only. There is no one fixed method. As far as exam is concerned, yes, they will mention the method. From that problem, whatever data available, we follow a particular method. That's a interesting part from exam point of view. Sometimes they will mention the method. Sometimes based on the data available, we will apply the appropriate method. But practical stuff, it's completely different since there is no boundaries. You can get any data and various resources are available. Okay, first let me understand some basic terminology. Value definition itself, there are so many things. Value, you can say present value, future cash flows, or you can say market value, at what value I can sell in the market, or at value I'm showing in the books, book value. Various opinions are there. Or if you look from returns point of view, investor point of view, the return percentage, IRR, internal rate of return, that is the rate of return generated by the company from its projects, you can say. From shareholders point of view, ROI, return on investment, that's our basic motto. From an investor point of view, if I invest so much, how much money I will get it back, that is ROI methods. Then valuation multiple, this method also there, we multiplied by times, like P ratio, one of the example we had discussed earlier. P ratio 5. If earnings of the company is 10,000, its value must be 5 times of it. So multiple method is also one of the methods. Terminology you should be aware of. Basic principle that you know already. Price is what you pay, value is what you get. Price is outflow, value is what you get. So at any point in time, we would like to maintain equilibrium between value and price, but at some times you'll find out the difference, and that is where we would like to use the opportunity. Okay, so valuation is concerned. Let's discuss theoretically. What is the meaning of valuation? It is measurement in monetary terms. It's the value of company, how much the company worth it, expressing it in numerical terms. We have different approaches. We don't have any standard here, accounting standard or law here. So these are the approaches defined by me in different textbooks, in different authors, different places. They define the heading in a different manner. So one I have divided as asset based. One is intrinsic value. Then we have enterprise value. Intrinsic value, or some people call it as book value, and so on. Like your accounting method, we prepare balance sheet, we prepare what is the assets and liabilities. Based on that, we can define what is the intrinsic value of a company. We have enterprise value. Enterprise value means from the entity point of view, not from the owner point of view. I'll give examples. Earnings based. The earning capacity of the company are also called as yield method. We have P ratio method, price to sales method, or some people call this as multiple methods. Relative valuation, earning capitalization, EV to EBITDA. I'm going to tell you all these things. EV to EBITDA, EV for enterprise value, EBITDA, earnings before interest, tax, depreciation, amortization. Cash flow method. Cash flow from equity shareholders point of view method. We have various dividend discount models. Cash flow for the entity method, we have two types, FCFF, FCFE, free cash flow to firm, free cash flow to equity shareholders. This is more important, the last part, as compared to all other methods. Okay, so first let me tell you, let's write down few things. This chart and all is there, is just to give you an overview, but we are going to discuss one by one, so there you understand. This is just to begin, just to start. Okay, so let's give the heading. You also write down along with me. Valuation of shares. Valuation of shares. Okay, write down. It is the process of finding worth of company or business. Worth of company or business. And one more question arises. When do you value company? For various reasons. If it's a listed company, for the traders, for the investor, we would like to know. If the company is being acquired, mergers, acquisition, one company will pay to another to acquire them. You need to know the value and so on. So when is it required? It's required in many places. So it is also going to be very integral part when we do the merger chapter, because merger essentially is about valuation of the companies, because you're acquiring another company. So those two chapters, you can say, are very much interconnected. So when we go to merger chapter, lot of formulas, concepts, what we use it here, we will be applying there. So don't forget when we come to merger chapters. Okay. Uh, Broadly, we have two methods actually. Let me quickly write down two methods broadly, or you can say two approach also. One approach is called as absolute valuation or absolute technique, and the other is called as relative technique. Okay, what is this absolute technique and relative technique? Absolute technique means purely based on your company's data, your performance, absolute. Like book value, you can say. Your company's value of assets, your company's value of liabilities, what is the net worth of a company? Purely on your company's data. That is based on data of particular company. Based on data of company under evaluation. We are looking at that company's assets, what liability they have, what income they have, everything based on that particular company. Whereas relative technique is comparison methods based on comparison method. What is comparison method? Like you can say valuation multiple. I'll explain that. Like P ratio, you can say. Like P ratio. What is that? Oh, in this sector, you can say, let's say Tata Steel is commanding 10 time P ratio. Tata Steel is valued at 10 times of its earnings. If Tata Steel is valued, JSW Steel or Jindal Steel also should be valued same 10 times. You understand? Company belonging to same sector, we will apply one company's ratio on another company ratio. Relative technique, comparison methods. This is the two technique we apply. Just keep it in mind. Methods we have many, but this is the two technique approaches we can apply. Absolute method purely on the data of companies under evaluation, like book value method. You can say like book value, and relative technique based on the comparison method. That company is going for 10 times, our company also should be valued 10 times. We are in the same sector. That is relative technique method, where we bring in comparisons. Okay. Then let's go for methods one by one. Okay. Then let us write down. Okay. Asset method. Asset based methods. Asset based valuation, you can say. Asset based valuation. Asset based valuation. We have book value methods. Then we have intrinsic value method. What is book value method? Book value method means book value. You are experts in accounts, you know what is shown in the books of accounts. That is book value of assets minus book value of liabilities divided by number of equity shares. Book value of assets, what is shown in the balance sheet, minus book value of liabilities, what is shown in the balance sheet. Liabilities divided by number of equity shares. Example I did not give you, you would already know it. Intrinsic value method. Instead of book value of assets, we will take market value of assets minus market value of liabilities divided by number of equity shares. Or some people also call this as replacement value method. Replacement value. Some people also have this method, replacement value. So what is intrinsic value? In the books, like for example, many times we might go for, in fixed assets, PPE, we follow cost model, cost minus depreciation. But the book value may not represent what is the market value. If you sell the asset today, what amount you get? Market value of assets. Or if I want to replace that asset today, that's a different issue, right? Computer you purchase for 50,000. Its book value now after depreciation coming to 20,000. But if I want to replace that relevant asset with your business, I mean that laptop, if you want to replace it in your business, the similar value of the asset, it might be more also, it might be less also. So you have market value method, replacement value method, that's what is intrinsic value method. But what is the main problem with this? I mean, it's of course easy to obtain, balance sheets are there, so anybody can get it. But the problem is, again, balance sheets are influenced. First of all, there might not be any consistency by we follow different accounting treatments. And then there's also chance that the management can fudge, management can play with some numbers. There are some possibilities. And one more disadvantage mainly is book value does not represent all the value, or book value or intrinsic value may not represent all the values of a company. For example, goodwill will be reflected in the books of accounts only when you acquire another company. You would know accounting standards, only purchased goodwill can be accounted. Internally generated brand, internally generated goodwill cannot be capitalized. Cannot be capitalized does not mean it does not exist. So if you are valuing a company, that internal part also you should consider. And that is why you see in many companies practically, you'll always find market price more than book value. Why? Because many factors may not have figured in. One more example I give. Pharmaceutical business. Research expense. What does your accounting standards Ind AS says? Research expense should be capitalized. Development expenditure should be, research expenses should be transferred to P&L. Development expenditure should be capitalized. Research expense means we don't know the benefit. In accounts, we always apply prudence concept. We don't know something, we are not sure something, take it to P&L. But that may not be true, right? That some benefit might be there, some probability might be there, but we would have expensed it off. But when an investor will consider those things also. So accounting will take prudence into principle. When you're not sure, you write it off. But as an investor, you don't go for that method. It's not reporting. You are valuing a company. So market price will always reflect or should reflect more factors than what an accountant would see. Because accounts objective is reporting. We want to be sure. We don't want to overvalue the company. So we will put it less. But investor will not worry about the overvalue, undervalue. We want the correct value. So we always like to average everything. So market price will always consider more factors than what is reflected in books of accounts. And that is why there is one ratio also. We call it as price to book. How much market price people are paying and how much is book value, what is the ratio? That ratio is also one of the parameter considered in valuation. So this is asset based valuation. We have enterprise value also. I will discuss it when it comes to various ratios. Hope you have taken down asset based valuation. If you have any question, you can ask. Okay, I'll go further. This asset based. Next is you'll say earnings based. Earnings based valuation. Okay. There's also one good dialogue in the scam, Harshad Mehta scam web series. It said whether old syllabus or new syllabus, there's one thing common. एक ही चीज common, one thing common, that is they say profit, which is very true. But nowadays that's also getting changed slightly. Anyways, ultimate objective of any business is what? Profit, which is true. And we also say this in short term, share price of the companies move by news, by sentiment, by sector movement, by government policy, and so on. Small news can have a big impact. Some news, chips in manufacturing of automobiles there is a shortage. All automobile companies, Tata Motors, Maruti Suzuki, Hindco, Bajaj Auto, everything will fall. News. That is where small news also, share price can fall. Jayalalitha died. Now, who is a competitor? Jayalalitha? DMK, Karunanidhi. Who owns Sun TV? Sun TV share price increase. That is, in short term, these events, news, gossips, rumors, small various kinds of things will influence market price. But in the long term, only one thing matters, that is profit. If you are making enough profit, you're profitable, you will make or you will have a good share price. So earnings based valuation. Okay, we have here earnings capitalization method. Earnings capitalization method. Earnings capitalization. What is simple earnings capitalization method? Is like, for example, you have a fixed deposit of 1 lakh and rate of interest of fixed deposit is let's say 8%. So how much income you get? I think 8% is high. Let's say I will select 5%. So what is the interest income? 1 lakh into 5%, that is 5,000. Now, if I tell you, you will get income of 8,000. You will have income of 8,000, same 5% interest. How much should be the value of FD? How do you calculate? Simple mathematics. 1 lakh into 5%, you got 5,000. If I go reverse, 8,000 divided by 5%, right? That's what is earning capitalization. The earnings or the income. Earnings divided by the expected return, or you can say ROI, required rate of return, whatever. You can say required return. Required rate of return. You can have, some people also call cost of capital. Required rate of return. Earnings capitalization. The value of business, you can say, or the value of company, you can say. Earnings from the business, earnings from the company divided by required rate of return. That is earnings capitalization or yield capitalization. There's also one more aspect. There's something called as controlling interest versus non-controlling interest. See, if you control the company, I'm acquiring 60% of another company. I control the operation, 60% more than majority. I control the operations. So earnings are in my control. If earnings are not in my control, I'm a small shareholder. I buy 5 shares. I have 1% of the shares capital in the company. So earnings are not in my control, dividend is in my control. So formula will become dividends by required rate of return. Just keep that in mind. Basic formula. Okay. Earnings based valuation, or you can say dividend capitalization. If it is small lot without controlling interest, dividend capitalization, that is dividends payable or receivable divided by required rate of return. Okay. Then we have valuation multiples. Valuation multiples. This is basically, you can say, relative valuation. Valuation multiple. Most important valuation multiple is PE ratio. Price earning ratio. PE ratio. Price to earnings ratio. P ratio. So what is P ratio? Formula wise, it is MPS divided by EPS. This is how you compute the P ratio. Price earning ratio. P for price, E for earnings. Price to earnings ratio. But we are not going to use it like this. What we are going to use is like this. Suppose we got the answer as market price currently is 50 rupees. Earnings per share is currently 10 rupees. So you say P ratio is 5. Means what is this 5 represents? Company is worth 5 times of its earnings. If they make 1 rupee profit, people are ready to pay 5 rupees. The company is worth 5 times of its earnings. So what is likely to happen? I will guess, I will estimate, I will try to predict the future EPS. I'll prepare income statement. How much sales will grow? How much expense will grow? How much profit before tax will grow? What will be the future income tax? How much will be likely to be our future EPS? Expected EPS. That EPS multiplied by this ratio will give me the expected market price. That is estimated or expected market price per share is given by estimated earnings per share EPS multiplied by PE ratio. PE ratio. So we'll estimate the future MPS earnings per share. So next year, now previous year, because of Corona and all, our earnings was less, or we are likely to make more earnings. It was 10 rupee EPS. Next year, we are coming to normal. Let's say we are estimating EPS of 20 rupees. P ratio of 5, that means it is going to be 100 rupees is my estimated market price. If actual market price is 80, I can simply buy the share, because I know it will go to 100 if this ratio holds good. And also one more way of doing it, this P ratio will not remain constant every year. I mean every time, it keeps fluctuating, right? Every day market price changes. So what do we do? P ratio. How do we take? For the stock, we take the low P ratio, high P ratio, we take an average. Or last 10 years, what is our historical average? That P ratio I will apply. Or I can apply industry P ratio. I am belonging to consumer sector discretionary industry, and the P ratio of that industry is 12 times. I am only 5 times, but industry is 12 times. That means my company share is undervalued as compared to the sector. So this stock should be purchased. Okay, I hope you have written down till here. I would like to give one practical example. I don't want practical example for all other things. Only for P ratio, I would like to spend time. I will spend a little bit more time only on P ratio. It is such an important aspect from practical point of view as well as from exam point of view. In so many places we will be applying this ratio. Of course, it has drawbacks, it has limitations. There are many people argue against P ratio. We'll come to it late. But let's understand the importance of this. Then we'll come to its limitations. Hope you have taken down. Let me go to internet. Okay. Hope this Google Chrome is visible. Uh, I'll go to screener.in. There are various websites. This is one of the reasonably good websites for me to compare various ratios. So I'll use this. Let's say I'll select Tata Steel, steel industry. Okay, let's look at its P ratio. Look at the P ratio. Who are all into this steel industry? Peers. You can see JSW Steel, Tata Steel, SAIL, Apollo Tubes, Tata Steel, BSL, Jindal Steel, and so on. Okay, let's compare their P ratio. You see, Tata Steel has got P ratio 4.5 and the industry P ratio is 5.18. So Tata Steel 4.5 is below industry P ratio. So I can tell Tata Steel is undervalued. Whereas JSW Steel is having P ratio 7.88 and that is higher than industry P ratio 5.18. So JSW Steel is overvalued. So all other things remaining constant, if I have to consider only P ratio as the basis, then I would invest in Tata Steel more than JSW Steel. SAIL, even more less P ratio, 3.43. Jindal Stainless Steel, 7.56. It is more. Okay. Now, I would like to go for one more company. Let's say I'll go for Nestle. Look at its P ratio. You will be surprised. Nestle Britannia, only two. Look at this Nestle, 83. Steel, 5. Nestle India, 83p ratio. Now you can't tell that this Nestle India is overpriced. It belongs to different industry. See, high P ratio means what? You have to understand. I repeat, what is this 83 means? If Nestle India makes 1 rupee, their value is 83 rupees, which means if I put it in a simple sentence, Nestle India value is 83 times its annual profits. How much ever its annual profit, annual earnings, 83 times its value. So P ratio is also a kind of confidence level. High P ratio means high confidence level. For this earnings, I am ready to pay more because Nestle India earnings are consistent, will not be fluctuating. Whereas the steel industry, the prices are very much fluctuating. It is not in our control. There are a lot of volatility in steel price. It's an infrastructure company. We don't know when the demand comes. We don't know when the raw material price increase, decrease. Whereas Nestle India, Maggi, everybody will consume. So sector also will play a very important role. And not only sector, high P ratio, you can also see high confidence level. Right? This company is making profits, but I'm confident they are a market leader. I'm confident. I'm ready to pay more. For the brand, we pay more, right? For Apple, for all practical reasons, forgive me if you're Apple follower, it is not having any utility value, right? It does same function apart from brand prestige, and for that brand you are ready to pay more premium. Similarly, in price also, if they command something brand, you are ready to pay more. So when something is more, does not always means it is overvalued. It also means it recommends a premium for its brand. Let me show you one more. Asian Paints. Let's look at its P ratio. It's paint industry, different industry. P ratio 95. Berger Paints 90. You see, these are all consumer oriented companies. Consumer discretionary, They command a premium also, but still is a different company. Let's look at infrastructure company. Let's say Godrej Properties, infrastructure, real estate companies. Look at its P ratio. DLF 62 times, Oberoi 36 times, Prestige Stage 47 times. Okay, Brigade Enterprises 414. P ratio is again much high. Maybe their earnings is given higher confidence. Let's look at Infosys, IT companies, TCS. What do their P ratio will be? See, 35 times, 30 times is around that range, 30 to 35 times. Industry ratio, P ratio 39. Hope you understand. P ratio basically means what is the value of the company in terms of its earnings. It's like value of house property in terms of its rental income. It is worth 10 times rental income, 20 times rental income. So we apply our own historical P, or we can apply industry P. It's basically a valuation multiple. We take the earnings, I apply the ratio, I'll get estimated market price. Since P ratio is very important, I spent little bit extra time. I will not be spending so much of time on other ratios. But P ratio is so much essential from exam point of view and from uh, practical application point of view as well. So if you have any question regarding P ratio, get it clarified. So a recent company which got listed, I'm not sure whether there's there. Nika, which got listed, 1625 ratio, crazy ratios. I really don't know whether they'll sustain. According to me, this purely is overvalued company. This is going to fall down, is my opinion. But Info Edge, Naukri, this is an amazing company in my opinion. They have Naukri, they have Policy Bazaar, they have Matrimonial, Shadi.com, one of them. They have stake in Zomato also, they have stake in Paytm also. This Info Edge is the platform business. Their P ratio only 10. I think it's a good time to invest. But anyway, some people don't have confidence. For that reason also value will be less. Because something is cheap, they may not be good. So you can argue in that angle as well. But in general opinion, high P ratio is costly, low P ratio is cheap. Okay. Good. So no questions. So let me get back. Okay. So ultimately what you do, you can say the formula expected market price is, if you know, EPS estimation, EPS multiplied by P ratio, or you can also tell total value. You can say market cap, market value of company. We say market cap. Market cap company is earnings of the company or estimated earnings or estimated net profit, estimated PAT multiplied by P ratio. That will give you the value of company. So you can also say P ratio is the confidence level. You can also say P represents confidence level. Not equals to, P also considers. Okay, so this is P ratio, valuation multiple. Let me quickly go to other ratios. We have now modern day technology ratios. What is modern day technology ratios? Zomato cannot have P ratio. They don't have earnings. All they have is losses. How do you value loss making company? We have some methods. That is, we have price to sales ratio method. Price to sales ratio. Price to sales. The formula wise, the price by sales, that is market price per share divided by sales per share. I mean sale value divided by number of shares, or market value of company divided by sale value. But how are you going to use it for estimating market price? Estimated market price is estimated sales multiplied by price to sales ratio. So various platforms like Byju's, they have so much of funding from VC, venture capitalist, P, private equity funds. Ola, they keep giving you discount. Paytm, there is a good joke going on. Paytm, that it got listed in IPO recently, and the news, the sentence was going like this: Paytm gave lot of discounts, and now they got listed, and they got all the discount back from the shareholders, because the share price fallen drastically. Retail investor suffered the loss. Anyway, estimate market price is based on the sales you make. So Byju's, Ola, Uber, they focus on, or even Zomato, Swiggy, they focus on top line growth, and that is why they give you so much of discounts. They're loss making, but they focus on sales growing. Even uh, this Geo gave everything free, because they did not want even sales to grow. They wanted customer base to increase. Geo gave so much of things free, almost for 1 year. Data free, voice free, message free. So they are not even making sales. But how did they value then? How do we value such companies? It's based on the users they create. Facebook, when they got initial funding, they did based on so many users they have. So many platform business I'm seeing now. Policy Bazaar, Matrimonial, or any lot of website platform based business. They look at not the sales, they look at the number of users. So we also have users to sales, or a price to users. So many users you create, value of the company is taken so much. Anyway, so price to sales is this. Then we have earnings capitalization, P ratio. One more important one is EV to EBITDA. EV to EBITDA. Okay, the ratio wise, ratio of EV to EBITDA is EV, enterprise value, divided by EBITDA, that is earnings before interest, tax, depreciation, and amortization. Okay, what is enterprise value? Let me tell you. Enterprise value basically means value of business, not value of shareholder. It is calculated by, you can say, shareholders funds plus long term loans. Basically, you can say capital employed, or you can say debt. I'll say shareholders funds plus debts minus cash. Even if you have any preference shares, non-controlling interest, minority interest, that also you add, minus cash. Minus cash because I want net debt. So as if you use the cash to make the payment, how much amount is you capital employed in the business. So that's why I'm subtracting cash, net debt. Anyway, what is this enterprise value? I'll give a very quick example. Suppose you purchase a house property. You purchase an apartment, 50 lakhs. You take a loan of 20 lakhs. You purchase a apartment, 50 lakhs. You take a loan of 20 lakhs. So what is your ownership there? What is your net worth there? 50 lakh minus 20 lakh, 30 lakhs. That is your investment. But if you are selling the house to somebody else, or on a Graha Pravesha, if somebody asks, your relatives ask, how much is property value? Will you tell, this is 50 lakhs, I have taken loan 20 lakhs, so my worth is only 30 lakhs? No, right? You always tell from property point of view, tell property is worth 50 lakhs. The loan does not matter. You might take loan of 20 lakhs, 25 lakhs, value of property remains same. That is how you value the business. Whether you take more debt or less debt, value of the property should remain same. That is what is enterprise value. That's why we are going for before interest, before tax. That is, before considering the impact of debt, what is the earnings you have? And based on that, you would like to value the company. So enterprise value is estimated or calculated by estimated EBITDA, earnings before interest, tax, depreciation, amortization into ratio. That is EV to EBITDA ratio. Then for enterprise value, I am going to subtract debt and add cash. So, or equity value is calculated by, from the enterprise value, you subtract net debt. From the enterprise value, you subtract net debt, and that is what is going to be your value of equity. So various ratio methods are, even price to book ratio we have. Let me quickly write. There is price to book. I mean, I'm not writing, but I'll just quickly telling. Price to book ratio. Market price per share divided by book value per share. That is how many times the market value in terms of book value. Suppose if the answer is 2, that means market value will be 2 times book value. What is the reason? I would have told you. And this is typically applied in banking companies. In banking companies, this ratio is used a lot practically. But anyway, in the examination, they should give you price to book value. If I know book value so much, if I can estimate book value, I can estimate the market price. Okay. So these are the various ratio methods or valuation multiple methods. Is many valuation multiples are there. Important ones we have covered it. Any questions so far? Okay. Then we have cash flow based. I'll quickly do cash flow based. Then I'll take up some more problems. So let me do cash flow based. Cash flow based. Now cash flow based from equity shareholders point of view. From point of view of individual. From the point of individual shareholders. Now, if you think from individual shareholder, what cash flow he gets? Cash flow, what individual shareholder gets is only dividends, correct? So we have dividend based valuation. We have dividend theories. Dividend based valuation. We have various techniques. I'm going to teach you that. Then we have from point of view of entity. entity. There again, 2 points are there. One is for equity shareholders, for all equity shareholders together, for all equity shareholders, or for the firm. How do you differentiate? For all equity shareholders, we have something called as FCFE, free cash flow to equity. Whereas for firm means FCFF, free cash flow to firm. Basically means FCFE is after interest cost. Because from equity shareholder, for the equity shareholders, interest is the cost. But FCFF is before interest cost, before the impact of interest cost. And from exam point of view, this is very, very important. FCFE, FCFF, free cash flow to firm, free cash flow to equity, we have discussed separately, and we have to do problems on this also separately. But I just want to give you an idea now itself. So I gave you this. Now cash flow, basic concept of cash flow, just keep it in mind. Cash flow can be, if it is one-time cash flow, you can write the what is one time cash flow. You can do whatever cash flow multiplied by discounting factor. One time cash flow multiplied by discounting factor, you get the present value. If it is recurring cash flow, recurring cash flow means 10,000 per annum for 5 years. Every year cash flow is same. Instead of discounting factor, what do? Then we do cash flow multiplied by annuity factor. And if it is perpetuity, perpetuity means cash flow forever. We have discussed perpetual bonds, that will be cash flow divided by required rate of return, cash flow by I. We have growing cash flow also. Those things we are going to discuss a little bit later. Just be aware of the various models, cash flow valuation models that we are going to apply. Hope you have taken down this part. Okay, we also have one more method called as the chop shop approach. I'll quickly tell you what is chop shop approach. Name itself will tell. Chop shop meaning cut. A company can have various segments. So, for example, Reliance has retail, Reliance has telecommunication, Reliance has petroleum. So, you value the first segment, second segment, third segment separately, and then you add all. That is called as chop shop approach. Segment valuation separately, then you do total. And there also we have quite a few applications, in the sense we have three methods. We can apply 3-4 methods. This segment I can value on price to earnings method, I can value on price to sales method, I can value on price to earnings and EV to EBITDA method, various methods. So if I have multiple methods, I can do one method, I can do second method, I can do third method, and then I can take an average. Chop approach. I mean, of course, when you do problem, maybe you'll understand better. Okay, let's go for some problems now.